Hey everyone, and thanks for jumping back into the macroverse. Today, we're going to talk about the most recent FOMC meeting. We're going to also discuss CPI. We got that data yesterday, and we're also going to discuss Bitcoin within the context of the Fed funds rate and pivots and whatnot in the Fed funds rate over a prior cycle. So if you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So I'm not going to try to spend too much time on each individual thing because there's a lot to talk about. The first thing I want to say is that the Fed has at least paused temporarily. Now, there is a chance that they could raise more as the year goes on. In fact, if you look at CME futures, the market is currently suggesting that there's about a 64.5% chance of another 25 basis point rate hike in July. Okay, so we need to understand that just because they've paused at this meeting does not mean that it is going to sustain. However, I would argue that there is a reasonable chance that they won't hike in July, right? I mean, even the market says that. I mean, 35.5% chance that they will not hike in July. And so that means there is a chance that this is the terminal rate. One of the things I've said before, back when this whole thing got started, was we talked about the idea of the terminal rate being somewhere between 5 and 5.5%. What's interesting is while a lot of people thought we would not get anywhere close to that level, the reality is there's a risk of going above that level. Okay? So the risk on it is more to the upside for the Fed funds rate than it is to the downside. I mean, we're well within the range that we suggested, 5 to 5.5%. We're still at 5.25%. But again, the risk remains to the upside. Okay, so if we do get one more 25 basis point rate hike in July, which is basically as far as the market thinks we're going to go, then that would get us to the upper part of the range that we laid out. What's interesting, though, is that the market is now not expecting rate cuts until 2024. One of the things that Powell said today, which I thought was interesting, is he said, and it shouldn't really come as a surprise, right? He said, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate. So the only way the Fed cuts this year, if something absolutely catastrophic happens, okay? So it's not that it can't happen. It's just that it's a very unlikely outcome, okay? If something catastrophic were to happen, then yes, you could see a cut this year, but I do not think it should be your base outcome, right? Like it shouldn't be your base case at this point. It doesn't mean that there shouldn't be some hedging going on related to that idea, but I think the base case should be that the Fed will stay higher for longer. Whether that means another 25 basis point rate hike or not, I know some committee members are calling for 2 more rate hikes. That remains to be seen. But at this point, we're still looking at 5.25% for the federal funds rate. As you can see, if you read it over here, it says in support of these goals, the committee decided to maintain the target range for the Fed funds rate at 5 to 5.25%. This allows the committee to assess additional information and its implications for monetary policy. I mean, what this means is basically there's long and variable lags in how monetary policy propagates through to the economy, and they are starting to see some potential softening in certain areas, and I think they just want to wait and see. Okay, there's also the stuff with the TGA that needs to get refilled, and so by pausing for at least a month, it allows some flexibility in other areas. Now, that's not to say that it is the terminal rate, because we could go higher, but it is at least a consideration at this point, because we now have paused, and the way in which it could become the terminal rate is if we see significant deterioration in financial markets sometime between now and July. All right. If inflation holds high at high levels, then yes, you could see another rate hike. Speaking of inflation, let's go through it. Headline inflation fell to about 4% year over year. Pretty substantial decline, and you can see that it's been moving down at a very steady pace. If you look at the monthly change of this, you can see it's been continuing to move down at, again, a fairly similar pace as it has been since July of 2022. And so this is good news, okay? Ideally, look, we talk about the risks all the time, okay? But in order to get to a sustained period of economic expansion, where we don't have to live in this environment of just constantly high inflation and worrying about what the Fed's going to do to combat that inflation, we need to see inflation get back down to the 2% target. Until that happens, right, we still do, of course, run the risk of the Fed raising and potentially pushing the economy over the edge. So headline inflation is looking like it's on the right path. I mean, in fact, at this rate, it wouldn't take that much longer to get down to 2%, right? I mean, we were at 6% in February. Now we're at 4% in May. Now, arguably, it could take longer to go from 4 to 2 than it did from 6 to 4. But we've also mentioned many times that during the second half of this year, it's more likely that we see rapid disinflation than hyperinflation. Remember, the first larger rate hikes did not occur until like last summer. So we're only just now getting to the phase where we could even say the economy is really starting to feel the effects fully of these rate hikes that have started to occur about a year ago. So we still need to see exactly the damage that the Fed has done to the economy. And I think by just waiting until next month to figure out if they're going to go higher probably does make the most amount of sense, right? I mean, I do think that actually makes the most amount of sense. And it actually could be, it could be a sign as well that if the Fed were very, very concerned, if they were overly concerned about inflation and they thought there was no issues at all in the labor market, they probably would have just hiked again. But watch what the Fed does, not what the Fed says, okay? So headline at 4.1, if you break it down into its constituents, you can see that a lot of the different categories are in fact coming down. So food and beverages coming down. This is what it looks like on a longer time period, right? So you can see that it's last month it was at 7.46, now it's at 6.58. I think it's likely just going to keep trending in the right direction. Okay, so that one's coming down. Housing coming down. This one's lagging a lot, but I think that you are going to start to see this really continue to move down. Now, housing prices have started to go back up a little bit, but I don't think it's going to cause a major headwind to this inflation year over year going too much higher from where it currently is. Apparel moved down briefly. It moved down slightly, which is a welcome change from last month where it went back up. So we'd like to see that continue to go down. If you look at transportation, it's actually deflationary. Note, I said deflationary, not disinflationary. Deflationary means prices are actually going down. You can see that it's a negative 1.68%. It was also negative a couple months ago as well. But again, that is one that actually historically is more likely to go deflationary, while other categories are less likely to do so. Medical care inflation continues to go down from 1.05% now to 0.724. So that's welcome news. Recreation inflation has dropped from 5.01 to 4.56. Education and communication has gone down. Other goods and services actually went slightly up. And that's it, right? I mean, those are the categories. So all in all, while there was one category that went up, everything else went down. And this is, of course, ideally what we want to see, right? We want to see this stuff continue to drop because we want to get to a period of more sustained economic growth rather than, the Fed raising rates and markets constantly having to react and figure out, okay, well, which companies are zombie companies and which ones are going to die out. A lot of them have died out. They're not black swans. It's just an artifact of tighter monetary policy. If you go look at core inflation, that is one that has been stickier because, as you will see, really ever since the year began, core inflation has been above 5%, right? January 5.55, then February 5.53, then 5.6, then 5.54. Now it's at 5.33. So it is a welcome move that it's, if you look at a monthly change, right, it is coming down, but it's still above 5%. I mean, it still is above 5%. So in order to have any chance, I think, of the Fed just pausing completely, we really need to see core inflation continue to drop next month. Okay, so if we can see it drop, well, it would be for this month, right? But if next month we get the data for core inflation and it's still dropping, that would be a very positive sign, I think. Now, the Fed has been pretty clear that they like to follow core PCE, and that one has not been as I mean, it hasn't behaved as much as we would like. As you can see, the most recent data point that we have, which, I mean, again, this was updated on May 26th, so we should get more data on this in what, like a week or two. The most recent data point, you can see that it actually went up. So ideally, we would like to see this drop considerably on the next reading, because this is one that has remained relatively sticky. We have not yet received a new data point. Again, the last update was on May 26th, not yesterday. So this is one that the Fed does follow a lot closer, and something that we need to take into consideration. Just as a reminder, the Fed, CME watch the watch tool over here. The CME group is still suggesting we get one more 25 basis point rate hike to get us to 5.5%, followed by a pause and then cuts starting in 2024. All right, so that's where we are with that. Now, if we go look at Bitcoin, one of the things that I want to discuss, and we've talked about this a lot, but I want to go through it again. It is dubious at best. All right, so we need to accept that. All right, I'm not here to tell you what has to happen or anything like that, but we've talked about this idea before, and I think given the recent events, it deserves our attention. Because if you're still here at this point in the cycle, pat yourself on the back. It's hard to stay this long, but if you've stayed this far and you don't make it through, you only have yourself to blame. All right, because if you're here now, I don't really think you're a tourist, but there are still a lot of people that will fall off, okay? Because they didn't think they were a tourist, but in reality, that's what they were. So I do hope you can stick around if you've made it this far into the cycle. Time-based capitulation is brutal, absolutely brutal. We've talked a lot about bearish outcomes, and I still do remain very skeptical of the altcoin market, and will remain skeptical until the dominance of Bitcoin is much closer to 60%. But we need, you really need to start thinking about some of these things and how they could play out, because once the business cycle, once the tail end of it gets here, where the unemployment rate starts to move higher, things can move quickly. Okay, so make sure you have a plan. One thing I want to talk about is how delayed the reaction function of the Fed has been this cycle. Okay, normally when the Fed is raising, they're raising into markets that are rising, right? They're raising into a strong economy. And I mean, normally you would look at this in the context of the S&P, but because most of you care about Bitcoin, that's what we're going to focus on in this video. The last business cycle, right, you can see the Fed was raising into a strong economy. They continued raising as the markets came back down. But at the end of the day, what happened? Bitcoin found its bottom when the Fed hit the terminal rate. That's when it found its bottom, okay? So there's going to be two ways to interpret this, and I don't really know which is the right way, okay? It could be a combination of both, but I'll tell you the one that we've talked about before, and then we'll talk about the secondary outcome. But I've said this before. There's this reality that the Fed is so far behind the curve, because normally they raise rates into a strong economy. This time, they didn't start raising until, markets in general were already heading down. Now, Bitcoin does not represent the entire market. I mean, the S&P has been going up recently while cryptocurrencies go down, but the S&P was also going down during 2022, and that's basically when the Fed started raising rates. They should have started raising rates in 2021. This is probably when they should have started. So here's the thing, though. In 2018, Bitcoin found its bottom, its low, once the terminal rate was hit. It then found its pre-halving year high once rate cuts began. It then found its secondary bottom, the secondary scare that we've talked about, on the last rate cut. Okay? So, 3 clear changes to Bitcoin's price trajectory based on what the Fed was doing. Pretty clear, right? I mean, it's pretty clear. You have a low, a high, and a low. And every single one of those corresponded to a change in monetary policy. Every single one. Now, what's going on this time? Now, the first reaction might be to say that, well, what does this mean? Does that mean that Bitcoin hasn't found its low because the Fed hasn't maybe reached their terminal rate? There's a chance the Fed goes higher to 5.5%. I don't actually know if that's the correct way to interpret it. The correct way could be to say, but it is something that we need to consider. The correct way could be to say that the market interpreted the shift from 75 basis point rate hikes to 50. That could more so mark what the pivot, right? The more so mark the actual pivot as markets have interpreted it. Okay? So instead of the terminal rate marking the low for Bitcoin, it was more so the pivot from 75 to 50, right? Therefore, instead of rate cuts corresponding to the pre-halving year high, perhaps it was the terminal rate, right? Again, we don't know if it's the terminal rate or not, right? It might not be, but there is a chance that this is the terminal rate. And if it is, then it actually marks the high pretty well, right? So one could argue that we're just following it one step behind from the last cycle, right? So this low marks what last cycle was the pause, and then this high was corresponding last cycle to a cut. Now it potentially just corresponds to a pause, okay? Because I know they didn't pause until this meeting, but if you just look at it, right, it was more so when the terminal rate was potentially reached. There's no guarantee this is the terminal rate, and I've said before they could go to 5.5%, right? They could. I don't really think they need to. My guess is that inflation is going to continue coming down regardless of whether they go another 25 basis points or not. But there's this idea then that the cut, right, the first rate cut could mark the secondary scare bottom, right? So whenever they cut rates, that could mark a potential low for Bitcoin USD. It could be a lower low compared to 2022. It could be. Remember, this low over here was potentially a higher low because the Fed came out and printed $6 trillion. Probably had some effect, right? With high inflation, they might be more hesitant to do that, okay? So there is a risk of that happening. Remember, in the 2015 cycle, we actually put in a double bottom. The secondary low came in August after the first one, which came in January. So it was January to August. And so we need to be aware that something like that could happen, okay? So perhaps a future rate cut, and maybe a future rate cut is the only cut. Maybe it corresponds to the first and last cut, and therefore all this gets grouped into one thing. Like if they just cut a significant amount in one go. Like that's a possibility, right? If they just go 100 basis points in one go, then maybe the first and the last cut are in fact the same. But we should at least consider this potential outcome where the first rate cut could mark the low, okay? So again, last cycle, it was terminal rate reached, Bitcoin bottomed. Rate cuts began, Bitcoin topped. Rate cut ended, Bitcoin bottomed. This time, shift from 75 to 50, Bitcoin found this low. Potential terminal rate, Bitcoin topped. Potential future cut, maybe Bitcoin bottom, right? The alternative way to look at it is probably a more depressing way to look at it, right? And that would be that if Bitcoin follows what it did last cycle, so during this rate hiking cycle, then that means that there's a chance that the terminal rate hasn't been reached, and perhaps Bitcoin finds its first low here once the terminal rate is reached. That's probably a more depressing way to look at it, right? It is something that we should consider. I mean, we should consider both outcomes, but we have talked about this for a while, the idea. And the reason we say this is because the Fed is so far behind the curve. I mean, normally they're raising when the markets are doing well. This time they didn't start until so much later. And so that is something that we have to consider. You know, we put out videos a couple months ago calling for a potential summer lull. I know that those views were not always met with the most thrilling response, but so far it seems to be playing out. I mean, Bitcoin has just kind of slowly gone down, right? I mean, I on any given day, we all get, we might question that thesis, right? On any given day. But when you sort of just zoom out a couple months later, has this not just been a slow bleed, right? A summer lull, if you will. So I think that there's a lot that we can learn from how monetary policy can affect risk assets like Bitcoin. A lot of people might assume that crypto is not going to. They might make the unfortunate conclusion that crypto won't survive because just because of all the regulation and stuff. But guys, that stuff's all noise. It's not, not completely right. There is the idiosyncratic risk of regulation that we have to consider. But at the end of the day, the thing that matters the most for Bitcoin, anyways, there's the altcoin market, there's Bitcoin, right? The thing that matters the most for Bitcoin, it's just monetary policy, as depressing as it is. And if you don't believe me, take a look at this. Take a look at Bitcoin divided by the money supply, okay? And would you care to see where we have a rejection on here? The same level we got in 2017. The same exact level. Where did we find this low in 2021? The same level. So what you're seeing here is this resistance level has now played resistance again, and once upon a time it played as support. So this is something that we have to consider, right? This is something that we must consider as we continue to navigate financial markets. How does the money supply affect these assets? You can see that Bitcoin was rejected, the same place that was rejected in 2017 when you account for the money supply. It was also rejected from the same place that it found as support in 2021 when you account for the money supply. Okay, so that's where we are right now. The business cycle is a long and grueling process, right? We're not trying to claim that it's easy and it's short. It's not. It's a long and grueling process, and I hope that I hope these videos have been helpful to people as we've navigated the cryptoverse. I know they're not always the most popular views, but my goal with all this is to not tell you what I think you want to hear, but it's to tell you what I actually think is going to happen. It's a hard thing because sometimes what I think is going to happen doesn't play out, and in that case, like people might get upset if it doesn't play out, and they would have preferred to have been, let's say, more bullish. But at the end of the day, I just want people to know that these views that I put out are so that people can manage their risk. I'm not trying to tell you what to do or anything like that, right? I just want you to manage your risk, because I've been wrecked in crypto so many times. And if I can save one person from going through some of the pain that I've gone through, especially with the altcoin market in bear market years and the pre-halving year and even the early stage of the halving year, then I would like to do that, right? I like to provide a perspective that might make people think twice before they go bet the family farm on some altcoin. So please remember that is my goal, is to just try to help provide this perspective so that people can navigate markets from a data-centric perspective rather than following what some person is shilling the most recent week. The thing with the problem with the altcoin market is that a lot of the people that promote these things for the last 18 months, despite the fact that they are just completely fighting the Fed on high risk assets. The Fed's, look, the S&P can climb the wall of worry, no problem. It climbed the wall of worry in 2019 too, right? Crypto did not, right? Crypto did not. So please understand that the altcoin market, the people that will shill these things to you time and time again, all they're ever going to do is just say the same thing until they're right, or they'll just stop talking about it. Please understand that my goal is to show you that, look, a lot of these altcoins will simply just go to zero. And you might argue that Total 3 could eventually find new highs one day, and I would say that there's a good chance that happens. But that doesn't mean that the altcoin that you hold has to see that high, okay? Doesn't mean that it won't, but history shows that most of them just go to zero. So please be understanding of that reality, that many altcoins will just sort of fade into oblivion, and that next cycle there will be a new class of cryptocurrencies that catch the eye of new investors. And some of the prior altcoins will could make new all-time highs. I think there probably will be a few that do. I always put that in because that way everyone can then think, can be comforted by the fact that, hey, maybe theirs puts in a new all-time high, because there's a chance that it does, and I don't want you to think that it can't. It's just that you need to be aware that if you're holding a basket of 100 different altcoins, there's a good chance that like 98 of them will not hit a new high. So just please be understanding of that. Tighter monetary policy is going to be difficult for cryptocurrencies to find a sustained bid, but it doesn't mean that they won't eventually recover once we get back to looser monetary policy. Okay, we'll wrap it up there. Thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up. Please do give the video a like. I know I probably don't say it enough, but it does help the algorithm. And again, we do have the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.